So let's talk about modern investing. What happens when you actually invest in the public markets or in the stock market? So let's take a stock for an example. Let's say Apple. And so a couple of years ago, Apple had its best quarter, its best year ever. You might remember this is when the bigger screens came out and their sales and revenue and profitability went through the roof. And so Apple made a lot of money. Incidentally, the stock price during that same time went down. So you have to ask yourself a couple of questions. Why did Apple's stock price go down? And it's because of speculation. Some analysts on Wall Street guessed on what they thought Apple would do. And they guessed a little too high, and that drove the stock price down. And so let's think about what happens when speculation and when other factors that have nothing to do with the business creates volatility in a stock. So let's talk about volatility for a second. That's when that stock price goes up and down. And our conventional wisdom has told us, just hang in there on that roller coaster. There's a little bit of an issue with that because volatility creates risk. A lot of people get those two things mixed up. So let's talk about risk. Risk is the probability of achieving a goal. I got $1,000, I want to grow it to $5,000. What's my risk in being able to do that? And here's how volatility introduces risk. Let's say you got $100. You lose 20%. How much money do you have? I hope you just said $80. It's very good. Very next day, you gain 20% back. How much money now do you have? Well, it's not $100. It's $96. So for every dollar you lose, you have to make $1.25 just to break even. So your probability of getting your goal just went down. So now that we know what risk really is, and that risk is a culprit when it comes to you creating financial security and long-term sustainable wealth, what are those things that increase risk? Well, what's happened now is our economy has become global, and that volatility that we just talked about has turned violent. You might remember, if you're old enough, back in, I think it was 1987, we had something called Black Monday. The market lost, get this, 500 points in one day. And everybody freaked. It just went crazy because they'd never seen anything like that. Fast forward to today. Now, the market may lose 1,000 points in a day. And people think that's normal. What changed between the way that people used to look at things and now? Did math change? I don't think so. Did economics change? I don't think so. We now have socially accepted the fact that losing money is a part of creating wealth. So that makes no sense. You don't have to lose money to create wealth. You may have to spend money, but you certainly don't have to lose it. Shouldn't there be better, more advantageous investment vehicles that allows you to really mitigate that risk and decrease that volatility over time?